It is 4:23 in the morning, and the world is asleep while the rules that govern money quietly change. Not through a vote, not through a press conference, not through a market crash, but through a document that almost nobody has read. A 287-page regulatory text released in Geneva, written in neutral language, buried in technical phrasing, yet carrying consequences large enough to reorder the foundations of global finance. In less than 24 hours, banks will wake up to a different balance sheet reality. The change does not announce itself with alarms. It does not ask permission. It simply activates. What makes this moment destabilizing is not speed alone, but silence. The most consequential banking rule since the aftermath of the 2008 crisis passed with virtually no public discussion. No congressional hearings, no televised debates, no market countdown clocks. By the time most investors notice anything has shifted, the incentives will already be locked in and the response already underway. Regulation, not speculation, will be moving first. The rule set is known as the Basel III Endgame. Its name sounds procedural, even anticlimactic, but its effect is neither. At market open, the definition of what counts as real money on a bank balance sheet changes for the first time in over half a century. Gold and silver, long treated as legacy commodities or speculative hedges, are quietly restored to a status they have not held since the early 1970s. Not by decree, but by classification. Not by ideology, but by capital math. For 53 years, since the closing of the gold window, precious metals were structurally sidelined. They existed in the system, but on its margins. Banks could trade them, leverage them, and sell claims on them, but they were not rewarded for holding them. In regulatory terms, they were inefficient, risk-weighted, penalized, something to be intermediated, not owned. That design shaped behavior for decades, encouraging paper exposure over physical custody, promises over possession, and leverage over reserves. The shock comes from how abruptly that logic reverses. Under the new rules, physical gold and silver held in strict, audited, allocated form are no longer treated as risky assets. They are treated as Tier 1 capital, the same category as cash, the same category as sovereign debt, assets that strengthen a bank's regulatory standing rather than weaken it, assets that improve capital ratios instead of diluting them. The shift is binary. One day, metals are balance sheet baggage. The next, they are balance sheet ballast. At the same time, the rules impose a parallel penalty. Unallocated metal, paper claims, futures, swaps, synthetic exposure, and short positions are reclassified as capital-intensive liabilities. They consume regulatory capacity. They require stable funding. They demand buffers. In plain terms, what was once cheap to hold becomes expensive overnight. What was once profitable becomes a drag. The system does not outlaw paper metal. It simply makes it uneconomic. This is where the paradox emerges. The regulation does not tell banks to buy gold or silver. It tells them how capital is measured. Yet the consequence is unavoidable. If holding physical metal improves a bank's regulatory posture, and holding paper metal damages it, rational institutions must respond, not out of belief, not out of fear, out of compliance. Balance sheets follow incentives, and incentives have just inverted. The immediacy matters. This is not a multi-year transition slowly absorbed by markets. The rule is binding at activation. Banks are given a short window to adjust, but the clock starts now. Capital planning, risk management, and treasury desks are forced into motion simultaneously. Some will try to unwind exposure, others will try to convert it. All will be competing for the same limited pool of physical supply. This is why the moment feels unbalanced. A regulatory decision has introduced a sudden, non-discretionary source of demand into a market that was never designed to absorb it quickly. The precious metals market is deep in price, but shallow in deliverable volume. It functions smoothly when flows are incremental and speculative. It destabilizes when flows are structural and mandatory. The difference is not sentiment, it is obligation. The silence surrounding the change is part of its power. Because it is technical, it avoids political friction. Because it is global, it bypasses national debate. Because it is framed as risk management, it escapes ideological framing. Yet its downstream effects reach far beyond bank capital ratios. They touch derivatives, markets, custodial structures, exchange inventories, and ultimately price discovery itself. The real destabilizing truth is this. When money rules change quietly, markets react loudly, but only after the fact. By the time headlines catch up, positioning is already uneven. Early movers are not speculators. They're institutions responding to rulebooks. Late movers are everyone else, reacting to price. This moment is not about predicting where gold or silver should trade. It is about recognizing that the system governing how they are treated has already shifted. The countdown is not to a crisis. It is to a compliance deadline. And compliance, unlike belief, does not wait. By tomorrow morning, the definition of safety on a bank balance sheet will no longer align with the assumptions most investors still hold. That mismatch is where dislocation begins. The rules are set. The incentives are live. The The adjustment has started, whether the public is ready or not. To understand why this regulatory shift matters, the structure that produced it has to be reconstructed from the inside out. The Basel framework did not emerge from ideology, nor from a belief in metals, currencies, or markets. It emerged from failure, specifically from the near collapse of the global banking system in the aftermath of the 2008 crisis, when balance sheets that appeared robust were revealed to be dangerously hollow. In the years leading up to that crisis, banks were optimized for return on equity rather than resilience. Capital ratios were thin, risk weightings were generous, assets that produced yield were favored over assets that absorbed shock. When liquidity froze, the system discovered that much of what counted as capital evaporated under stress. The response was not political punishment, but regulatory redesign. The Bank for International Settlements, headquartered in Basel, Switzerland, sits above national regulators. It does not lend to the public. It does not run elections. Its role is architectural. It sets the standards by which banks measure safety, solvency, and survivability. After 2008, the BIS concluded that the system failed not because of one product or one country, but because capital definitions themselves were flawed. Basel III was the corrective framework. Introduced in stages, it tightened leverage ratios, introduced liquidity coverage requirements, and redefined what qualified as high-quality capital. The objective was simple. In stress, capital must remain. If it disappears when needed most, it is not capital. Over 15 years, the framework rolled out in phases, each addressing weaknesses exposed by stress tests and market events. What was left unresolved until the final phase was precious metals. Gold and silver occupied an ambiguous position. They were liquid, globally recognized, and historically monetary, yet they were treated as risk assets. The reason was not philosophical, it was operational. Most bank exposure to metals was not physical, it was synthetic. Unallocated accounts, derivatives, and paper claims dominated. Regulators were unwilling to grant capital status to instruments that could not be delivered under stress. This distinction hardened into policy. Physical metal required custody, auditing, and clear title. Paper metal required none of those. Banks gravitated toward the latter. It was cheaper, it was scalable, it fit the leverage model. Over time, the paper market grew exponentially relative to physical supply. This imbalance was tolerated because it appeared stable. As long as few demanded delivery, the system held. The Endgame phase addresses that structural vulnerability. It does not rehabilitate metals out of nostalgia. It separates metal that can absorb stress from metal that amplifies it. Allocated, segregated bullion with clear ownership does not default. It does not rely on counterparties. It does not vanish in a liquidity freeze. Unallocated claims do. The regulation simply encodes that reality. By granting zero risk weighting to physical bullion and imposing punitive treatment on synthetic exposure, the BIS closes a loophole that allowed banks to treat leverage as liquidity. The framework aligns incentives with survivability. Assets that endure stress are rewarded. Assets that fail under stress are penalized. This is not a metals thesis. It is a capital adequacy thesis. The historical parallel is instructive. Prior to 1971, gold functioned as settlement collateral between states. When convertibility ended, gold was not banned. It was marginalized. Central banks retained it, but private banks were disincentivized from holding it. The monetary system shifted toward trust in sovereign debt and fiat liquidity. That trust expanded leverage. Leverage expanded fragility. Basel III Endgame does not restore a gold standard. It restores optionality. It allows banks to hold an asset that does not depend on another institution's promise. In doing so, it implicitly acknowledges that trust alone is insufficient as a foundation. Capital must be real, not theoretical. The timing matters. This rule arrives after a decade of unprecedented balance sheet expansion by central banks, rising sovereign debt, and declining confidence in long-term fiscal discipline. Regulators are not predicting collapse. They are preparing for stress. The metals provision is one component of a broader attempt to harden the system against scenarios where paper claims become unreliable. The context, then, is not a bet on price. It is an admission of limits. The system recognizes that leverage has boundaries and that assets outside the promise chain have a role. Gold and silver re-enter the framework not as relics, but as insurance instruments embedded directly into capital rules. Understanding this reframes the narrative. What appears sudden is the final step of a long process. What appears radical is actually conservative. The BIS is not chasing returns, it is constraining risk. The consequence is unavoidable demand, but the cause is structural fragility. By the time markets react, the regulatory logic will already be embedded. This is how systemic change usually arrives, quietly, methodically, and only obvious in hindsight. The critical pattern revealed by the Basel III Endgame is not about metals themselves, but about how power flows through balance sheets when rules change. Markets often assume that prices move because opinions shift. In reality, the most decisive movements occur when incentives are rewritten and choice is removed. What the new framework exposes is a mechanical truth. When regulation changes capital efficiency, behavior follows regardless of narrative. Banks do not operate on conviction. They operate on ratios. Every asset on a balance sheet must justify its existence through regulatory math. Under the old regime, precious metals failed that test. They consumed capital without improving ratios. Paper exposure, by contrast, allowed banks to intermediate demand without owning supply. That structure created a vast synthetic market layered on a relatively small physical base. The endgame breaks that equilibrium by imposing asymmetry. Physical metal becomes capital accretive. Paper metal becomes capital destructive. This is not a moral judgment. It is a cost function. Once applied, it cascades through internal risk models, treasury allocation, and trading desks simultaneously. The pattern is uniform across jurisdictions because the framework is global. The first mechanical consequence is short covering. Banks that maintained net short exposure in metals did so because it was cheap. Shorts generated fee income and trading profit without tying up equity. Under the new rules, that logic collapses. Short positions now require additional Tier 1 capital buffers. Equity is the most expensive form of funding a bank has. Using it to support a position with limited upside becomes irrational. The moment the rule activates, maintaining a short position becomes a negative return proposition. Even if price remains stable, the capital cost overwhelms the trade. This forces an unwind, not selectively, systemically. Each institution faces the same calculus. Covering becomes the dominant strategy, not because of fear, but because of arithmetic. The second consequence is conversion pressure. Banks holding unallocated positions must decide whether to close them or convert them into allocated form. Closing reduces exposure, but forfeits client relationships and revenue streams. Conversion preserves business lines, but requires physical acquisition, storage, auditing, and insurance. Both options involve cost. Neither allows inertia. Here, the physical constraint asserts itself. The paper market allowed infinite scaling because claims could be written faster than metal could be mined. The allocated market cannot. Every ounce requires custody. When multiple banks attempt conversion simultaneously, demand becomes concentrated in time. Supply does not respond symmetrically. Mining output is fixed in the short term. Recycling is price sensitive but slow. This mismatch produces a third effect. Price is no longer the primary regulator of demand. Compliance deadlines are. Banks must demonstrate progress toward compliance regardless of price volatility. This shifts the demand curve from elastic to inelastic. When buyers must buy, price loses its rationing function until after the requirement is met. The pattern resembles previous regulatory squeezes, but with a crucial difference. In most cases, regulation restricts leverage, cooling markets. Here, regulation redirects balance sheet capacity toward a scarce asset. The result is not contraction, but displacement. Capital flows out of assets that consume regulatory bandwidth and into assets that restore it. This displacement has secondary effects. To fund physical acquisition, banks must liquidate other holdings. Typically, these are liquid sovereign bonds or short-term securities. Selling pressure is diffuse but real. It tightens financial conditions at the margin. Higher yields are not the objective, but the byproduct. The pattern extends further into derivatives markets. As unallocated exposure becomes costly, market makers reduce offered liquidity. Bid-ask spreads widen, volatility increases. This feeds back into risk models, further penalizing synthetic exposure. The loop reinforces itself. Paper markets shrink not by decree, but by attrition. Crucially, this is not driven by investor psychology. Retail demand is irrelevant at this stage. The actors are institutions constrained by rulebooks. The timeline is compressed because the penalties are immediate. Delay offers no advantage. Early compliance reduces supervisory scrutiny. Late compliance invites it. What emerges is a classic regulatory squeeze, but applied to a market that was never designed for rapid physical settlement. The scale of synthetic exposure relative to deliverable supply means that even partial conversion strains inventories. Each ounce allocated removes optionality from the system. Each conversion tightens the remaining float. This is why the effect is nonlinear. The first conversions are manageable. The later ones occur in a thinner market. Price responses accelerate not because fundamentals change, but because structure does. Once confidence in paper liquidity erodes, remaining holders reassess their own exposure, amplifying demand. The pattern also reveals why timing matters more than valuation. Traditional analysis asks whether metals are cheap or expensive. Regulatory analysis asks whether exposure is permitted or penalized. When the latter changes, valuation anchors dissolve. Price discovery becomes a function of compliance velocity. The deeper mechanism at work is remonetization through constraint. The system is not declaring metals money. It is forcing banks to treat them as capital if they wish to use them at all. That distinction is subtle but decisive. It transforms metals from tradable instruments into balance sheet infrastructure. Once that transformation begins, reversal is unlikely. Regulatory frameworks rarely retreat once implemented. They accrete. Adjustments may be made at the margin, but the core classification endures. The pattern, once established, becomes the new baseline. This is the mechanism markets underestimate, not the narrative of metals returning, but the mathematics of capital following the path of least resistance. When rules change, behavior aligns. The rest is consequence. The logic revealed by the Basel III Endgame is not new. It is the same logic that has repeatedly reshaped financial systems when regulation collides with scarcity. What changes is the object, not the mechanism. To see how this unfolds, it is useful to examine modern parallels where capital rules, not market sentiment, forced repricing across entire asset classes. After the 2008 crisis, sovereign bonds were elevated within regulatory frameworks. They received preferential risk treatment, often zero risk weighting, regardless of fiscal trajectory. Banks responded predictably. Balance sheets filled with government debt, not because yields were attractive, but because holding it improved capital ratios. Demand was regulatory, not discretionary. Prices rose, yields fell. A structural bid was created that persisted for more than a decade. That episode illustrates the core principle. When regulation embeds demand, markets decouple from traditional valuation metrics. Bonds did not rally because debt burdens improved. They rallied because rules made them efficient to hold. The same pattern is now being applied to a different asset, under different conditions, but with identical force. A second parallel can be found in post-crisis liquidity rules. The introduction of the liquidity coverage ratio forced banks to hold high-quality liquid assets sufficient to survive short-term funding stress. Again, the response was mechanical. Institutions reallocated portfolios toward assets that satisfied the rule. Markets adjusted. Liquidity premia compressed. Assets outside the favored category experienced relative neglect. In each case, regulation did not forecast outcomes. It engineered them. The outcome was a secondary effect. The primary effect was compliance. The same is now true in precious metals. Banks are not making a macro call on inflation or currency debasement. They are optimizing under constraint. The modern context amplifies the effect. Unlike bonds, physical precious metals cannot be issued to meet demand. There is no central authority that can expand supply in response to regulatory preference. This makes the parallel more volatile. In bonds, regulatory demand lowered yields. In metals, regulatory demand tightens availability. Another parallel lies in derivatives reform. After 2008, over-the-counter derivatives were pushed into central clearing. Margin requirements increased. Capital charges rose. Certain trades became uneconomic. Volumes migrated or disappeared. Price behavior changed, not because risk vanished, but because leverage was constrained. Here again, the lesson applies. When the cost of carrying a position exceeds its utility, institutions exit regardless of belief. Paper metals now face that fate. The capital charges imposed on unallocated exposure mirror those imposed on uncleared derivatives. The expected outcome is shrinkage, consolidation, and a migration toward instruments that satisfy regulatory criteria. The difference is that in metals, the compliant instrument is physical custody. That introduces logistics into finance. Vaulting, auditing, and title transfer become financial functions. This blurs the boundary between commodity infrastructure and monetary infrastructure. In effect, the system is rediscovering that not all assets are abstractions. The modern parallel also extends to currency regimes. When capital controls are imposed, money flows around them, not through them. When capital incentives are imposed, money flows into them. Basel III Endgame functions as a capital incentive. It does not ban fiat. It does not mandate metals. It simply makes one path more efficient than the other. This efficiency differential matters most in an environment already under strain. Today's system is characterized by high sovereign debt, persistent inflation pressures, and limited policy flexibility. Central banks are constrained. Fiscal authorities are overextended. Trust in long-term stability is uneven. In such an environment, regulatory signals carry disproportionate weight. The parallel to the early 1970s is instructive, but incomplete. Then, the system broke under external pressure. Now, it is being reinforced internally. The reintroduction of metals is not reactive, it is preemptive. Regulators are embedding shock absorbers before the shock arrives. Another modern comparison lies in collateral frameworks. Central banks accept certain assets as collateral at preferential haircuts. Those assets gain liquidity and status, others lose relevance. Over time, collateral eligibility shapes markets more decisively than investor preference. Basel III applies this logic to bank capital itself. What distinguishes this moment is the convergence of regulatory demand with public unawareness. When sovereign bonds were elevated, markets noticed quickly. When liquidity rules changed, banks adjusted quietly. Metals sit between those extremes. They are widely followed, but poorly understood structurally. This creates a lag between cause and recognition. The modern system also differs in speed. Information travels faster. balance sheet adjustments propagate through markets in near real time. The transition period exists, but behavior shifts immediately. Anticipation becomes action. This compresses the adjustment window and magnifies volatility. Perhaps the most important parallel is psychological. Market participants are conditioned to look for narratives. They expect price moves to be justified by stories. Regulatory-driven moves resist storytelling. They appear arbitrary until the framework is understood. This gap between explanation and action is where dislocation persists. In past cycles, those who recognized regulatory incentives early positioned ahead of repricing. Those who waited for confirmation paid higher prices. The same dynamic applies here. By the time metals are discussed as Tier 1 assets in mainstream commentary, the adjustment will be mature. The modern lesson is clear. Systems change, not when beliefs shift, but when rules do. The Basel III Endgame is not an isolated event. It is part of a broader trend toward embedding resilience into the architecture of finance. Metals are one component. The pattern is larger. Understanding this parallel reframes expectations. The question is not whether this change matters. It is whether one recognizes its effects before they become obvious. Regulation moves first. Markets follow. Narratives arrive last. The Basel III Endgame does not announce a revolution. It engineers one, quietly, mechanically, and without asking for belief. This is how durable systems change. Not through declarations, but through constraints that redirect behavior until the outcome feels inevitable in hindsight. What is unfolding is not a speculative cycle driven by enthusiasm or fear. It is a systemic realignment driven by compliance. Banks are not choosing metals because they expect dramatic price appreciation. They are choosing them because the rules now treat physical reality as safer than abstraction. In a financial system built on promises, that distinction matters more than any forecast. The deeper implication is philosophical rather than tactical. For decades, the global system operated on the assumption that liquidity could substitute for substance, that paper claims, properly managed, could replicate the function of reserves. Basel III Endgame quietly withdraws that assumption. It does not reject paper instruments. It simply refuses to pretend they are equivalent to assets that exist without counterparty risk. This is not nostalgia for a bygone era. It is risk management in an era where complexity has outpaced confidence. Regulators are not forecasting collapse. They are acknowledging uncertainty. In uncertain systems, assets that do not rely on continued coordination gain value, not because they are superior, but because they are independent. The reclassification of gold and silver as Tier 1 capital signals something broader. It signals that the system no longer fully trusts its own scaffolding. Sovereign debt remains central. Fiat currency remains dominant. But the framework now admits that redundancy matters, that resilience is improved by diversity of foundations. There's a caution embedded in this shift. When regulation begins to privilege assets outside the promise chain, it reflects concern about the promise chain itself. Not imminent failure, but structural strain. High debt, persistent deficits, demographic pressure, and geopolitical fragmentation all test the assumptions that underpin fiat stability. The response is not abandonment, but hedging at the institutional level. This institutional hedging has consequences for everyone else. When banks adjust balance sheets, markets adjust prices. When markets adjust prices, narratives scramble to keep up. Those narratives often focus on surface explanations, missing the underlying cause. The risk for individuals is mistaking the effect for the driver. The true driver here is not inflation, geopolitics, or speculation, though all may interact with the outcome. The driver is classification. What counts as capital determines what institutions must hold. What institutions must hold determines what becomes scarce. Scarcity determines price. Once this logic is understood, the volatility that follows becomes less mysterious. Price swings are not signals of sentiment, they are symptoms of adjustment. As paper markets contract and physical demand concentrates, the system searches for a new equilibrium. That search is rarely smooth. The cautionary element lies in timing and access. Institutions move first because they must. Individuals respond later because they can. By the time responses are voluntary, conditions have changed. This is not unfair. It is structural. Regulation operates upstream of markets. Those closest to the source adjust earliest. There's also a warning about complacency. The system did not fail loudly in 2008 until it did. Prior to that moment, risk was invisible, dispersed, and assumed manageable. Basel III is an attempt to avoid repetition by embedding resilience before stress manifests. Metals are one expression of that attempt, not its entirety. The broader message is that financial systems evolve by reweighting trust. When trust in abstractions is high, leverage expands. When trust is questioned, systems gravitate toward anchors. These anchors need not dominate, but they must exist. Gold and silver are not returning as rulers of the system, but as reference points within it. This reframes expectations for the future. The outcome is not a return to old monetary regimes, nor a rejection of modern finance. It is a hybrid architecture that acknowledges both efficiency and fragility. In such a system, assets that endure stress without negotiation gain institutional relevance. For observers, the lesson is methodological. Watch rules before watching prices. Understand incentives before interpreting charts. When regulatory math changes, behavior follows regardless of commentary. The most important shifts often occur before they are discussed, not after. For the system as a whole, the endgame represents a quiet admission. Stability is not guaranteed by complexity alone. It requires assets that remain when coordination fails. By embedding those assets into capital frameworks, regulators are conceding that resilience must be tangible. The Basel III endgame will not end volatility. It will not prevent crises. What it does is alter the terrain on which future crises play out. Banks that hold assets outside the promise chain carry different risk profiles than those that do not. Over time, that difference compounds. This is how history usually records turning points. Not as moments of drama, but as dates when definitions changed. When what counted as safe was redefined. When incentives shifted beneath the surface. The world notices later. The system adjusts immediately. What began as a technical document becomes, in retrospect, a marker. Not because it declared metals money again, but because it acknowledged that not all value can be abstracted indefinitely. In doing so, it quietly reshaped the architecture of trust. That is the significance of this moment. Not a rally, not a prediction, but a reclassification that will echo through balance sheets, markets, and narratives long after the document itself is forgotten.